Brent crude fell below the $70 per barrel level yesterday. The US yields and the US dollar plunged and the bank sold off. So today, all eyes are on the US CPI update, which is expected to provide the final confirmation that the US Federal Reserve is clear for next week's interest rate cut. So welcome. This is Swissquote's Daily Market Talk. So yesterday was an awful day for oil traders who were expecting at least a small rebound in oil prices, if nothing, due to the tropical storm Francine that's actually leading to lower production in the Gulf of Mexico. But no, the barrel of US crude tumbled almost 4% at yesterday's trading session to nearly $65 per barrel level as Brent crude slipped below the $70 per barrel psychological mark after OPEC, which is normally optimistic, lowered its demand forecast for the second time in just 2 months. Then the API data also showed that the US oil inventories fell by another 2.79 million barrels last week. As such, US crude has now hit the oversold market conditions, and the rapid sell-off that we saw recently actually suggests that a minor upside correction would be healthy at the current levels. But it is a sure thing that the trend remains to the downside as the demand worries right now outweigh the supply side of the oil story. So the price supportive factors like the geopolitical tensions in the Middle East, OPEC's decision to delay the end of its production restrictions, and also news like a hurricane, a tropical storm in the Gulf of Mexico go totally unheard. So little need to say that the energy sector of the S&P 500 had a rough trading session yesterday. Elsewhere, the debate between Donald Trump and Kamala Harris went quite well for Harris yesterday, which saw her victory odds climb to 55%, and the latter sent Bitcoin 2.5% lower after the debate. And other than that, yesterday was a day full of mixed news for big banks and big technology companies. First, we heard that the US regulators decided to scale back the increase in capital requirements for banks from 19 to just 9%, which is excellent news, mind you, for the banks, because that's all the money that the big banks won't need to put aside, but rather put to work to earn more money out of it. Yet, the news were eclipsed by a conference where the big bank heads actually gave quite weak revenue prospects and also gloomy outlook for the coming quarter. So JP Morgan's CEO, for example, he said that the $90 billion estimate for its net interest income is not very reasonable for next year. Then the Bank of America said that results for its investment banking will be lower than Wall Street expectations. Then Goldman Sachs CEO came up and he said that the bank's trading revenue will likely drop by 10% in the current quarter. And finally, Ally Financial warned at the very same conference yesterday that credit challenges have intensified, and that's due to increasing auto loan delinquencies as borrowers face higher borrowing costs. So as a result, JP Morgan saw its share price drop more than 5% yesterday, and Invesco's KBW Bank ETF fell 1.83%. Voila! That wasn't a good day for the big banks, even though note that the banks actually rebounded more than 63% since last October dip and have had quite a good year so far, and that despite the tightening economic conditions in the US and elsewhere in the world and rising macroeconomic challenges. Now, as I was saying before, another sector which actually woke up to not so great news yesterday was the big technology. So Europe's top court told Apple to pay Ireland 13 billion euros in unpaid taxes, putting an end to an 8-year dispute. And separately, Google lost its chance to overturn a 2.4 billion euro fine, still by the Europeans, for abusing its market dominance of its shopping comparison service. So that was not very good news for the big technology stocks. Now, Google's Alphabet didn't really react to the news, to be honest with you. Its stock price gained 0.31% yesterday, while Apple lost 0.36%, but most of it was probably due to the unimpressive product revealed and insufficient AI promises that the company gave just the day before. On the brighter side of the technology news, Taiwan's exports rose to a new record of 43.6 billion US dollars in August, thanks to the growing demand for AI chips. And the country's finance ministry said that, well, the exports should continue to rise steadily in the second half of this year, thanks to robust AI demand. So, Nvidia advanced on 1.5% yesterday, but TSM gave no reaction to these good news, and to me it actually looked like the continuation or part of the AI fatigue story. Because let me tell you this, a few months ago such news would have triggered a decent market rally, but this time around it did not. So just saying. Now, anyway, overall, looking at the markets and zooming out, the S&P 500 still gained 0.45% yesterday. Nasdaq 100 index jumped 0.90%, while the Dow Jones Industrial Index closed the session with losses due to the bank sell-off. On the bond side, the US 2-year yield plunged to 3.56% yesterday on rising worries regarding the economic strength, and the US dollar gave back most of its advance since Monday this week. The dollar again fell to the lowest level since January. Ladies and gentlemen, as a Bank of Japan member, well, he said that the central bank will continue to adjust its degree of easing. And because the expectation is that the Bank of Japan will likely wait until December or even January next year to announce another interest rate hike in Japan, there is, well, some more room for hawkish readjustment right now, but the 140 psychological level for the dollar yen will likely act as a decent support in the absence of a concrete action or a concrete forward guidance. Now, today, all eyes are on the US CPI data. Before we go further, Adobe's digital price index printed the biggest drop on record in August for online grocery prices. So, according to their calculation, the online food prices in the US fell 3.7% in August from a month earlier. Now, food consumption stands for about 8.6% for the official inflation measure, and it is obviously left outside of the core inflation measure because food prices tend to be volatile. But the decent drop fits well within the slowing economy and slowing inflation narrative. And that, combined with the falling energy prices of right now, I will say that the direction for consumer prices looks pretty clear to me. Now, in numbers, core inflation in the US, that excludes food and energy prices, is expected to have steadied near the 3.2% level. But headline inflation in the US, which includes the volatile food and energy prices, is expected to have eased from 2.9 to 2.5%. So if that's the case, well, we will see the US headline inflation drop significantly below the 3% level for the very first time since last summer. And that would be just another good reason for the Fed to stop worrying about inflation and just to continue to worry about the weakening jobs market. Now, would that justify a 50 basis point cut instead of a 25 basis point cut in September? Hardly. Because announcing a 50 basis point cut in September would simply suggest that the Fed officials accept to have fallen behind the curve and that the things are no longer under their control. And to be honest with you, I don't really think that they want to do that at this stage. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below as usual. Follow us on Instagram, on X, and on LinkedIn for regular market updates. Subscribe to our YouTube channel for daily market comments. And please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow. And until then, good day trading.